Welcome to vTalkInsight, Risk Sentiment Daily for December 18th, 2025. Global markets are digesting a sharp equity pullback, rising volatility, and fresh questions around AI and bond market hedging. We will unpack what is driving today's late cycle, risk-off tone, and how easing expectations, earnings, and positioning are shaping the path into 2026. Across global markets, the balance of signals today points to an environment that is late cycle and clearly risk-off in the near term. Major U.S. indices have moved lower again, with the S&P 500 now in its fourth straight decline and closing below its 50-day moving average, while the Nasdaq 100 has tested its 100-day line. That pattern fits with a daily S&P loss of more than 1% and volatility indices edging into the high teens, suggesting investors are paying up for protection as they reassess how much risk they want to carry into year-end. The risk-off tone is being amplified by pressure in the very areas that had carried the market higher. AI-linked mega-cap tech names, including NVIDIA and Broadcom, have led the sell-off, with NVIDIA now almost 17% below its October peak. Technical breakdowns in AI-heavy benchmarks and concerns over heavy spending plans are undermining confidence in the growth trade. At the same time, options markets are showing elevated demand for both downside and upside protection, with out-of-the-money puts and calls pricing in more turbulence than at-the-money structures. Implied volatility may even be understated because of holiday effects, meaning underlying risk perceptions are higher than the headline gauges suggest. Yet this is not an outright capitulation. Forecasts for U.S. growth remain surprisingly resilient, with some houses projecting GDP near 3% next year, helped by AI-driven productivity and ongoing fiscal support. A series of strong earnings beats from AI-exposed chipmakers, biotech, and other cyclicals reinforces the idea that corporate profits can absorb some macro bumps. On policy, inflation expectations are described as well anchored near 2%, and central banks from the Federal Reserve to the Bank of England are either easing or preparing to, even if the exact timing and pace are debated. That combination of growth, earnings, and prospective rate cuts continues to offer a cushion beneath the current pullback. Putting it together, today's risk sentiment is best described as late cycle and risk-off, but still underpinned by structural supports. Price action and positioning argue for caution, while AI-led growth, disinflation, and ample liquidity keep longer-term scenarios more constructive. In this setting, incoming information on AI fundamentals, inflation, and yields has an outsized ability to move markets, with both upside and downside surprises likely to be magnified by crowded positioning. The clearest bearish force right now is risk-off price action and positioning. Major U.S. equity indices have rolled over, with the S&P 500 slipping below its 50-day moving average and the Nasdaq 100 touching its 100-day after several consecutive down sessions. Commentary highlights this as a notable shift from the earlier grind higher, especially because the weakness is concentrated in prior leaders like AI and large-cap tech. That makes the drawdown feel more significant than a simple mid-cycle pause. Options markets confirm the change in tone. Demand for out-of-the-money puts and calls has increased, and those structures are now implying more volatility than at-the-money options. Adjusted for seasonal effects around upcoming holidays, implied volatility measures such as the VIX are effectively higher than they appear on the surface. Traditional hedges are also under strain. High-quality bonds have not reliably offset equity losses, while gold is approaching record highs and silver has already reached one, underlining a rotation toward alternative safe havens as investors search for portfolio ballast. Positioning data add another layer of vulnerability. In Europe, equity investors report record high bullishness, with more than 90% expecting gains next year and many looking for double-digit returns. Cash allocations among European managers have dropped to their lowest levels since 2013, leaving limited dry powder to support dips. Similar crowding is visible in sectors such as defense, where institutional holdings have nearly tripled prior peaks, and in parts of the AI complex. When enthusiasm is that one-sided, even modest disappointments can trigger outsized moves as investors all head for the exits at once. There are offsets to this negative skew. Despite the Nasdaq's decline, underlying breadth has been relatively resilient, with many stocks outperforming the index and select areas like biotech and parts of cyclicals delivering strong relative gains. One major house still holds a 12-month S&P 500 target near 7,750, while explicitly allowing for 5 to 10% pullbacks along the way. The takeaway is that price action and positioning are driving a tactical risk-off episode, rather than a wholesale unwind of risk. However, given how crowded some trades have become, the bar for negative surprises remains low, and volatility spikes are likely to feel sharp when they arrive. A second major bearish driver is AI infrastructure and valuation concerns. The collapse of a high-profile $10 billion data center financing linked to Oracle and Blue Owl has put a spotlight on how AI capex is being funded. Blue Owl's hesitance to provide capital, the sharp sell-off in both Oracle and its financing partner, and widening credit spreads around Oracle highlight unease about debt-heavy structures backing massive AI build-outs. Investors are increasingly questioning whether balance sheets can comfortably support these ambitions. Beyond a single transaction, the episode raises broader questions. Hyperscalers are shifting more data center financing toward private equity and private credit, pushing risk onto pensions and other long-term allocators. At the same time, rapid advances in AI efficiency could make some large-scale facilities obsolete within 5 to 10 years, increasing the risk of stranded assets. Local political resistance, concerns over power and water usage, and signs of strain in parts of the private credit market add to this unease. These factors collectively challenge the assumption that all AI infrastructure spending will earn its cost of capital. Valuation pressure is building on the listed side as well. AI-linked megacaps such as Nvidia and Broadcom have led the recent sell-off, with Nvidia now well below its recent highs and seen as a key barometer for the entire AI trade. Multiples on sector leaders appear to have peaked, and investors are demanding stronger, more visible earnings delivery. There is also debate about the durability of the current memory chip upcycle, which has already run longer than usual. If earnings and revenues do not keep pace with expectations, today's premium valuations could quickly look stretched. Counterbalancing these risks, the fundamental AI story remains powerful. Chipmakers such as Micron and another leading memory producer have reported earnings and revenue meaningfully above consensus, with robust guidance driven by AI-related demand and tight supply for high-bandwidth memory. Demand for AI data center infrastructure is still described as running ahead of supply, even supporting investment in new power generation. Potential deals like Amazon's proposed $10 billion investment in OpenAI, including the use of its own AI chips, underline continued capital and competitive intensity in the space. For markets, this means AI can continue to support growth and earnings, but dispersion between winners and losers is likely to rise as financing and valuation risks become more differentiated. The third key bearish driver is elevated yields and weaker bond hedges. Despite growing expectations for rate cuts, long-dated U.S. Treasury yields remain high, with many market participants expecting the 10-year yield to stay closer to 5% than 4% over the next several years. Investors point to persistent fiscal deficits, concerns about inflation that may not fully return to target, and heavy Treasury supply as reasons why the term premium remains elevated even as policy easing is discussed. Yield curve steepening is expected to persist as long-end supply increases and demand dynamics shift. That steepening reduces the effectiveness of long-duration bonds as portfolio hedges, just as equity volatility is rising. Recent episodes have already shown that treasuries can sell off alongside stocks, undermining a long-standing diversification anchor. Investment-grade credit spreads remain tight, meaning that much of the yield on offer is simply compensation for rate and duration risk rather than underlying credit risk. In many parts of the bond market, investors are therefore receiving limited incremental compensation for taking on additional spread exposure. With traditional hedges under pressure, safe haven metals have absorbed some of the demand. Gold is approaching record levels, supported by geopolitical tensions, commodity volatility, and worries about fiscal sustainability, while silver has already broken to new highs amid a structural supply deficit and strong industrial demand. These moves illustrate how elevated yields and weaker bond hedges are reshaping the toolkit for managing macro risk. The more bonds trade as another pro-cyclical asset, the more market stress is likely to express itself through volatility spikes, safe haven flows, and sharper cross-asset rotations. On the bullish side, AI-led growth and earnings resilience remain a central support for risk assets. Some forecasters now see U.S. GDP growth around 3% next year, notably above consensus, citing AI-driven productivity gains and continued fiscal stimulus as key tailwinds. AI is described as the dominant force behind equity performance, to the point where traditional diversification by geography or sector is less effective unless investors make a deliberate call on AI exposure. Recent earnings reinforce this narrative. Micron and another major memory chip maker have both delivered revenue and profit meaningfully ahead of expectations, with guidance upgraded on the back of strong demand for high-bandwidth memory used in AI applications. Gross margins have surprised to the upside, and free cash flow is improving sharply. Elsewhere, biotech equities have surged, with one index up about 30% in the second half of the year, helped by lower inflation and falling rates. Strong corporate earnings more broadly, alongside a normalization in monetary policy, underpin a constructive near-term outlook for equities despite volatility. Looking ahead, several strategists expect market leadership to broaden as AI-driven productivity spreads beyond a narrow set of tech names. Sectors like healthcare, materials, and consumer staples are seen as potential beneficiaries into 2026, while rate cuts are expected to support interest rate-sensitive areas such as housing, regional banks, and emerging markets in 2025. The main risk to this bullish driver is that AI fails to deliver the revenue and earnings implied by current valuations, or that financing stresses in data center and infrastructure projects constrain the build-out. For now, though, the combination of strong reported results and credible growth forecasts keeps AI at the core of the medium-term upside case. Another supportive force is global disinflation and easing expectations. In the United States, Federal Reserve officials emphasize that inflation expectations remain well anchored near 2%, reducing fears of a renewed inflation spike. Recent commentary suggests the Fed is likely to shift its primary focus from inflation to labor market weakness over the coming year, with some forecasts calling for policy rates to fall toward 3% by the end of next year and additional cuts possible in 2026. Across the Atlantic, the disinflation trend is even clearer. UK inflation has surprised to the downside, with November headline inflation falling to 3.2% and continuing a steady downtrend since September. Markets are now pricing a greater probability of multiple Bank of England cuts in 2024, and gilt yields have moved lower across the curve. In the euro area, downside risks to inflation are building as wage growth slows, the euro strengthens, and energy base effects fade. While the European Central Bank is currently on pause and some policymakers sound more hawkish, the broader backdrop points to inflation near target and limited pressure for further hikes. These dynamics have already supported pockets of risk-on behavior. Biotech, housing-related assets, and parts of credit have benefited from expectations that real rates will fall, while precious metals have attracted flows as investors position for a weaker dollar and looser policy over time. However, the easing story is not one way. U.S. inflation remains above target. Services inflation in the UK is still elevated around 4.4%, and some Bank of England and ECB officials continue to warn against premature cuts. The net effect is a bias toward eventual easing, but with enough uncertainty to keep rate expectations and term premia volatile. The third bullish driver is supportive liquidity and deal activity. Despite bouts of volatility, credit conditions and market liquidity are described as solid, with the Federal Reserve maintaining ample reserves in the system. State Street, for example, sees no major liquidity or credit risks despite recent equity pullbacks and high concentration, viewing the current environment as one where market dips have so far, been absorbed rather than spiraling into funding stress. Primary markets underline this resilience. The Medline IPO, a large private equity-backed offering, was oversubscribed and closed up more than 40% on its debut, while other deals such as Wealthfront have come to market despite modest growth metrics. U.S. M&A values have reached a 4-year high, driven by large-cap tech activity and a pickup in IPOs, suggesting a friendlier backdrop for corporate transactions heading into 2026. In parallel, private credit demand continues to grow as asset managers integrate public and private lending into broader fixed income strategies, and energy transition funds are reporting record exit activity and strong returns. Innovation is also evident in digital assets and retail channels. Institutional interest in tokenized funds and indices is rising, with major banks launching tokenized money market products, while retail investors continue to show strong risk appetite through options and crypto trading. Even within crypto, flows are rotating rather than exiting entirely, with outflows from Bitcoin and Ether ETFs offset by inflows into Solana and XRP products. Together, these themes point to a financial system where liquidity and deal activity remain supportive for risk-taking, even as valuations and macro risks demand more discrimination. To wrap up, today's landscape is dominated by a late-cycle, risk-off tone driven by weak equity price action, AI-related valuation and financing worries, and elevated yields that blunt the protection investors once relied on from government bonds. Against that, AI-led growth and earnings, disinflation and eventual policy easing, and a still vibrant liquidity and deal environment continue to provide powerful offsets. The interaction between these forces suggests a market that is vulnerable to shocks but not devoid of opportunity, with outcomes likely to be shaped by how AI fundamentals, inflation data, and long-end yields evolve from here. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.